All right, so we had a very crazy week in the markets, a lot of volatility, mainly to the downside. Wednesday was a good day, partially because of the Fed meeting. Although if you actually look at the timing of that, most of the gains actually happened before the meeting even came out. But I think most people knew basically what was going to be said. When you look at Powell, again, they're never going to be 100% transparent on what they're going to do going forward. They typically have to hint or forecast, but they never say directly what they're going to do. But coming from this week, the chances of rate cuts, again, it's 99% chance we're getting rate cuts this year. The market right now, I believe, is pricing in between 50 and 75 points. Now, that would imply that one of the meetings, they're going to cut 50 basis points, which is kind of interesting because if you look at virtually all of the major Western banks that have cut so far, it's always been 25 basis point cuts. So it's going to be interesting to see how that goes. But the jobs data came in a lot weaker than expected, and that is what brought down the markets on Thursday and Friday. Both days were pretty weak days. And when you're trying to look for trends in the market, typically if you have a very weak day preceded by a very weak day, usually that's not necessarily a long-term trend, but that probably is establishing a short-term trend. If you look at the markets here, the S&P was down, I believe, about 2.5%. Yeah, 2.5% almost exactly. If we look at the NASDAQ, I believe the NASDAQ was down about 4%. Yeah, NASDAQ down 4.2. Small caps were down even more, I think. Small caps got hit the hardest, partially because of the dollar being hit a little bit. Yeah, small caps about 4.8. I think mid caps actually did the best. I believe they were down about 2. Yeah, 2.3, so a little bit less than the S&P. And then if we want to look at the equal weight index here, I believe the equal weight definitely did outperform. The equal weight actually hit a new all-time high this week at about 173, but then it trended back down again with the market. But if we look at the equal weight index on the week, it was actually only down 1.7, which is the best out of any of the categories. So, like I mentioned before, we are seeing, number one, we're seeing a pullback in the markets. And number two, we're seeing a rotation. And honestly, it's mainly into the more of the value names. And when you look at the SPY compared to RSP, the SPY is skewed towards growth, RSP is skewed towards value, and that's why value is outperformed once again. So for the rest of the year, like I said, I think value is going to outperform compared to growth. And I think the mid caps probably will do the best. It kind of depends on the dollar and on the broader economy as a whole, because if that continues to weaken, small caps will get hit. Also will depend on rates and that kind of stuff, but my opinion of the markets going forward is, I think near term choppiness, we probably break lower, but again, we could break higher before we break lower. The real question is, do we go, like when the market trends back up again, does it break to new highs? Because if it does, that would establish an uptrend. If it doesn't, that would continue the downtrend narrative, right? It's basically the simplicity of lower lows and lower highs, or higher highs and higher lows. Which one of those breaks out? And I think in the coming weeks we're going to find that out. Also, again, September, we're going to see a rate cut. It's just a matter of, is it 50, is it 25 basis points? Honestly, it's looking like, I think it's slightly more likely to be 50 basis points where we're at right now, but obviously nobody knows. Nobody knows what's going to happen with the markets, but I think we probably break, when it comes to the S&P, I think we're going to break to about 10 to 15% down, maybe 20%. We would need to see worse things happen for us to go more than 15, maybe 20% below. To go lower than that, I think that, again, something more major would have to break. And I don't think there's any signs of that where we speak right now. I think we're going to see a run-in-the-mill pullback just like we did last year at this time. If you look at last year, I believe the markets bottomed in the summer. We had a pullback, and then they bottomed again in October. I think a similar thing will happen. Again, the timing won't be exact. Also, again, we have the election coming up in November. Probably either way, I think we see a near-term bounce coming out of the election, because I don't think either candidate is necessarily great, at least for the markets. But when you look at the stock market, typically what they like most is certainty. So once we know who the candidate's going to be, at least we know at least what to expect going forward. So either way, I think we see a little bit of a bounce in the markets post-election, and I think we close the year at an all-time high, or at the very least, we close the year going into an uptrend. That's my prediction. But I think near term, over the next month or 2 or 3, we probably break to new lows, maybe not yearly lows, but at the very least, we go lower. I think the S&P is down about 6% from its highs. I think, like I said, if I was setting betting odds, I would say between 10 and 15% is where I would expect things to bottom out. Now, again, we could trend to a new high before that happens. So don't try and time the market. I've said time and time again, and I think virtually every quote-unquote expert will tell you, timing the market is never a good idea. My strategy is very simple. Buy good companies for a good price. You find companies that are good, which honestly is fairly easy to do. The hard part is being patient enough to and to be able to recognize when they're on sale. That's the hardest part. So my strategy going forward, have your watch list ready to go every week or 2 or however often you want to do it. Go over that watch list. Have price targets or valuation targets. Go over the companies. And if the market's coming down, chances are more and more companies are going to be at a fair price or even on sale. So simply have a watch list, keep an eye out, or even set price targets. That's another option as well. But keep an eye out. When you hit those price targets, that's when you pull the trigger. That's my strategy. Again, I think it works pretty good, but again, I'd love to hear what other people would think on that. Getting into earnings on this week, we had 3 of the Mag 7 companies release. The best one was Apple. Apple released pretty good earnings, and Apple has been the best performing of the Mag 7, at least going back over the very long run. Technically, again, NVIDIA, if you go back like a decade, but very few people knew of NVIDIA stock 10 years ago. My point there is Apple, I guess a better way of putting it is not that they performed the best, because they haven't. The best way of putting it would be Apple is the most well-established. If I were to only hold one stock for the next 30 years, it probably would be Apple. It probably would be Apple, because they're the most well-established. They probably have the best brand, especially in North America, and they have a very good product line. They're profitable. They're buying back shares. They're paying a dividend. They're growing that dividend. So at least as far as the Mag 7 goes, Apple is my favorite. They probably won't perform the best, at least share price return, but I think they're the safest of them. At least not that they are truly safe, because no stock is, but I think they're the safest, and they still have a good amount of room to grow. So that is Apple. Again, they released good earnings. Again, they were actually up on the week. On a week when the markets were down 2, 3, 4%, especially the growth, the large cap growth getting killed, to perform this well, I think is a very good sign. Microsoft, they released, I didn't do that ticker right. Microsoft released solid earnings. The only problem they ran into was cloud revenue was down. And right now, AI is all the hype, which to some degree, I think that there should be a little bit of hype there, but I think the hype is overblown, because AI definitely is going to make a difference in our lives, but it is receiving too much hype. And I think this is part of the reason why we're seeing a pullback in the growth side of the market, specifically the large cap growth side of the market, is because too much growth no pun intended, has been priced into these companies. And when you look at Microsoft, even though they were down, I think 4% roughly on the week, 4.5%, they're still expensive. And I mean, I think they're down over 10% from their all-time highs. They're still trading at a 41 price to free cash flow. Like, that's still way too expensive. They'd have to come down another probably 15 or 20% before I would be interested. I would pay 25 price to free cash flow probably is the max. That would imply like a 25% pullback, just roughly off the top of my head. So too expensive, very good company, but they're just too expensive. The last of the big seven is Meta. Meta, they easily beat earnings and revenue. They were up on the week, although they did kind of sell off as the week ended. Meta, I've never been a huge fan of Meta just because even though they've performed extremely well and they appear to be a very good company, I don't think they necessarily have as much of a moat as an Apple or even a Microsoft has. I don't see it. So that's why I'm not necessarily sold on Meta. Now, if you could get them for the lows, like below 300, yeah, like a lot of people were picking it up. I remember seeing them there, and I didn't pull the trigger. They are below their historical valuations, but I still think they're a tad expensive. I would say price to free cash flow of like 20. If you could get them below 20, I definitely would be picking them up. But I mean, because the numbers are all great. I mean, the analyst projections, the financial health, the growth, the management, the profitability, it's all good. The problem with these really large companies is that for them to double in value, it's going to take a heck of a lot more effort than a company that has like a $10 billion or even $100 billion valuation. So that's why I'm a little skeptical of all of these mega cap companies. Getting into the other companies here, McDonald's, they missed revenue and earnings. A very rare bad week for McDonald's. Although they were up on the week, which is kind of odd, but nonetheless, kind of rare to see. McDonald's is actually, they're below all their historical valuations, but they're too expensive, right? They're still too expensive. A 27 price to free cash flow, a 23 PE. They would probably have to be below 20 on a price to free cash flow basis before I would pick them up. Although, given how safe and how well of a brand they have, if they ever got to a fair value, even though I don't think you're going to see crazy growth. I don't even know. You probably see, 7-8% returns per year. Given how stable they are, at least over the long run, McDonald's is a company I definitely would pick up if you could get them for a good price. Procter & Gamble, I don't think I ever would pick them up just because I don't see them being able to grow well enough. But they did beat earnings, although they missed revenue. Again, I do watch them because they're one of the biggest, if not the biggest, of the consumer staples company. I'm not sure off the top of my head. They were actually down quite significantly after releasing earnings, ironically enough, but then they closed the week actually up, which is kind of odd to see. But again, a lot crazier things have happened. American Tower, they're one of the biggest REITs, if not maybe the biggest REIT. I'm not sure off the top of my head. They did release very good earnings, and they were up nicely on the week. So REITs are actually one of the few areas that have actually done well over the very recent timeline, namely because interest rates are projected to go down. So I think that's done good for REITs. I think one of the only of the at least companies I have that I have at least a decent sized position in, and it was up this week, was Vici Properties. So again, REITs are an area where definitely, again, if you don't have a good sized position in, or a fair position in REITs, you'd want to definitely look at that. I'm not saying buy right now necessarily, but definitely keep an eye out. Cameco. I don't own Cameco, but I do own the URA ETF, which would hold Cameco. Yeah, so I technically have indirect exposure to Cameco. They released good earnings. They did beat earnings in revenue, although they were down on the week, and I think that was mainly due to the larger uranium sell-off. And the one thing of note here is I think uranium is definitely, a lot of these companies are at a very good price right now. I mean, URA is down to like $25 a share, so I'm definitely picking up more there. And I think that if we're going to transition to renewables, transition away from fossil fuels. If we're going to do that, uranium is pretty much or not uranium, but nuclear is pretty much our only option. So that's something that I think pretty much everybody should have exposure to. And not only that, even if we're not going to transition, it's still a good idea because uranium is very underrated. I'll just put it that way when it comes to energy. The next one here is Enterprise Products Partners. This is one of the better oil and gas names, I think. They did miss earnings and revenue. They were down on the week, and I think that's mainly due to pretty much all the major oil companies have released kind of shaky earnings recently. This company, again, you're buying mainly because of the dividend, 7.37%. I don't think you're going to get crazy price returns, but I actually bought this company, I remember probably like 2 or 3 years ago at like $21 a share, and I sold it at like 25 or 26 thinking I was super smart, and sure enough it's up another 10 or 15% plus that 7% dividend since then. So this is definitely a company to have on a watch list if you can get it for a good price, and you're looking at buying more oil and gas names. This is one that I definitely do like. Ares Capital, they're one of the bigger BDCs. Actually, they might even be the biggest BDC. They did beat earnings and revenue. Again, these kind of companies you're really only buying if you need income, given the 9.5% dividend. They're not necessarily going to provide good share price returns, but you are getting a nice juicy dividend. I would never make these a large position because the vast majority of them, if not all of them, will underperform the S&P, the NASDAQ, small cap, mid cap, virtually any broad market index over the long run, and I'm talking like 10, 20 years. But if you're looking for, I have a certain amount of money, I want income over a very short period of time, whether it's a year or two or whatever, these companies, they're not a bad idea, at least in my opinion. Pfizer, this is an example of a company that I definitely would never touch. Again, a lot of people get caught up on the 5.5% dividend yield, but most pharmaceutical companies you should not touch with a 10-foot pole, and the only ones you should touch are the ones to where you're willing to do a absolute ton of research to understand their product line, their patent cliffs, et cetera, et cetera. They did beat earnings and revenue, although they were basically down slightly on the week. SoFi, this is one of the bigger, a lot of like the YouTuber, the YouTube finance community, for lack of a better way of putting it. This is one of the more popular names on there. They are losing money, although earnings and revenue were up, and they raised guidance, but they were still down on the week. So I think that's more of a sell-off in the growth type names. This is a company that, again, I have on a watch list. I do watch, but I'm not necessarily super confident that I'm ever going to buy them, even if they did come to a good price, because they're not even making money right now. And if a company's not making money, very, very unlikely, 99% chance you shouldn't buy a company if they're not making money. UFPI, this is a company I do have on a watch list. I definitely would pick some up if you could get it for a good price. They did beat earnings and revenue. They were down a little bit on the week, though. A10 Networks, I do own a very small position in this company. They did beat earnings, but they missed revenue, and they were down on that news. But they basically chopped sideways for the rest of the week, right? So that's actually kind of a good sign if you own them, to be honest. AMD, again, obviously one of the more popular names out there. They did beat earnings and revenue, although they were down on the week. Although it doesn't look like they were down quite as much as the market was. Let's take a look here. Actually, sorry, they were down 8%. So I got caught up looking at this big run up after earnings. So after earnings, yeah, they were up quite a bit, but they were still down 8% on the week. They're still way too expensive. I think they're a solid company, but they're still way too expensive. A price of free cash flow of 158, like that's just absolutely insane. Way too expensive. They would have to come down to probably like $40 or $50 a share based on current earnings to be at a good price, at least in my opinion. The next one is Arista Networks. I really, really like this company. The only problem, they're a phenomenal company. They're just too expensive. They did beat earnings and revenue. Phenomenal company, just too expensive. Looks like they were down ever so slightly on the week to about the same as the market, about 2.4%, which is actually kind of good considering they are a large cap growth name. Extra Space Storage, they did beat revenue, or sorry, they beat earnings, but they missed revenue. They were actually up on the week, and I think that was mainly due to the real estate play. A lot of these REITs and the companies in the real estate industry are doing good because rates are expected to come down, and that will help them out. So, like I said, keep an eye on a lot of these better real estate names, because if you can get them for a good price, probably not a bad time to buy, especially if we get a pullback. Little Fuse, I used to own this company. Beat earnings and revenue. They were down on the week. OVV, this is an oil and gas name. I have on a watch list. I think there's some better options, so I've never actually bought, but I do think they're decent. They missed earnings and revenue, again, similar to EPD. Skyworks, I do have a very solid position in this company. They beat earnings, but they missed revenue. They were down quite significantly on the week. They were actually bordering on getting to the point to where I'm probably going to stop dollar cost averaging them, but then they came right back down again, and I think they are still at a buy point, at least in my opinion, where they're at right now. Starbucks, I almost pulled the trigger on Starbucks on their recent pullback. They're back to about $75, $76 a share. I would want to buy them below $70, at least based on current earnings. If they did that, I would pick them up. Beat earnings, missed revenue. They're actually up slightly on the week. POWL, Powell Industries. I have them on a watch list. I probably would buy them if I could get them for a good price. They were actually up a lot after earnings, and they actually sold off, but they're still up on the week. They released good earnings, beat earnings and revenue. So, again, this is an example of a very solid company. If I could get them for a good price, I definitely would be buying. Altria, a very popular name amongst dividend investors. They missed earnings and revenue, although they were basically flat on the week, which is kind of surprising considering they were up on the last few days of the week, which is kind of surprising, but nonetheless, they were up. I would never buy them, though. I just think there's better options. I don't care if they have a 7.7% dividend yield. I think there's companies that have a comparable dividend that are better than them, and I think that there's companies that have higher dividends that are better than them. So not a company I would ever own, but I do watch them because they're popular. Automatic data processing. They released good earnings. They beat earnings and revenue. They were up on the week. This is a company that if we have a recession, I think probably would sell off quite significantly. But I'm kind of surprised that they released a weaker jobs number, and yet they still did pretty good. I'm kind of surprised there, but nonetheless, I think this is a very solid company. If you could get them for a good price, I would be buying for sure, but I never have. Boeing, another example of a company that I never would buy. This is an industry I never would touch either. They missed earnings and revenue. This is an avoid at all costs. This is a company that if they were selling for $10 a share, I still wouldn't be buying them. Just my opinion. But again, in my opinion, I think they're an avoid at all costs. CDW, I really like this company. I am buying them right now. They missed earnings and revenue. They were down on the week, but again, I'm not concerned. I think the long run outlook is still good for them. LECO, this is a company I do have on a watch list. I probably would buy if the price was fair. They beat earnings and revenue, while they were down on the week. So keep an eye there, but I do like this company. TT, this is Train Technologies. Beat earnings and revenue, although they were down on the week. But I really do like them. This is another company that I have on a watch list. I probably would buy if they got to a good price. ARM Holdings, they were one of the most popular, if not the most popular, new companies of this year. They just went IPO within the last year. I don't remember when, but they released shaky earnings. They beat earnings, but they missed revenue. And I mean, they're barely profitable. This is an example of a growth name. I mean, they don't even have data here. I have them on a watch list. I'm watching. I don't think I ever would buy though, because I think they're too expensive. They're too growthy, and there's too much hype for me. But again, that's just my opinion. CP, they released good earnings. They beat revenue and earnings. If they were at a fair price, this is another example of a company I would buy. Again, they're a railroad company. They're boring. They're not exciting by any means. but they have a very good moat, and they're in an industry that's going to see growth. So that's why I do like them. ACLS, I do have a small position in this company. They missed revenue, but they beat earnings. I think they were down a little bit on that news. Yes, they were. They're in the semiconductor industry, and the semiconductor industry has seen a sell-off recently, and I think that's why, is because a lot of those companies were overvalued, and when you see a rotation out of growth, semiconductor names are going to sell off naturally. Lam Research, they beat earnings and revenue, although they were down on the week. And again, I think this is just another example of a very good company. They release solid earnings. They're selling off because the market is selling off, not because they're a bad company necessarily. Musa, this is Murphy USA. This is another example of a company I have on a watch list. I've never bought, but I might buy if it got to a good price. They did beat earnings, but they missed revenue. They were up on that news, though, so kind of surprising there. Paycom Software, I do have a small position in. They're kind of hard to predict because the last earnings report, they kind of lowered their guidance, which caused me to become kind of skeptical of them. But then now they kind of raised it again, so I'm kind of unsure what to think of them. But they appear from the outside looking in to be a very solid company, but I think this is an example of an area where you would need to do some more digging to figure it out for sure. Riot, they're one of the largest Bitcoin miners or crypto miners. I'm not sure if they do just Bitcoin or crypto in general. They released kind of shaky earnings. They were down very significantly on the week. Teladoc Health, they're one of the more popular of like the Cathie Wood type stocks. They did beat earnings, but they missed revenue. They were down quite significantly on the news, and they're not even making money. So definitely a company I would not touch. And speaking of Vici Properties, they released solid earnings. They were up on the week. They actually raised guidance as well. So I do like Vici Properties. I did buy more of them around like $28, $29 a share. I wish I would have bought more, but again, you live and you learn. ConocoPhillips, they did miss earnings and revenue. Although they weren't down that much on the week. This is one of the better oil and gas names, I think, though, so definitely worth keeping an eye on. IBP, Installed Building Products. They did beat earnings and revenue. This is a company I definitely do like. I probably would buy if you could get it for a good price, but I think it still has to come down a little bit further, just from the outside looking in here. They are actually only a tiny bit above their historical valuations, but I think they would have to come down probably another 10% or so before I would be interested. The next one is ITT. I definitely really like this company. I've made a video about it before. They released solid earnings. They did beat earnings and revenue. And when you look at them on the week, they were down, right? They were down, but I think that's mainly due to just a larger market sell-off. Square, this is Block. They released good earnings. They did beat earnings and revenue. And looks like they were down slightly on the week. Coinbase actually released pretty good earnings. They did beat earnings and revenue, although they were down on the week, and I think that's more or less due to just the market as a whole selling off. DraftKings, they did beat earnings, missed revenue. DraftKings is a name that I don't know why people are so in love with this company, mainly because it is almost impossible to develop a moat in this industry, so that's why I'm not necessarily a fan. Microchip Technologies, they did beat earnings, but they missed revenue, and I think they sold off with the semiconductor and growth sell-off as a whole. MPWR, I think a similar story here. They did beat earnings and revenue, although they sold off mainly due to semiconductor names selling off. I do really like them, though. If I could get them for a good price, I definitely would be buying. MicroStrategy beat earnings and revenue, although they were down on the week, and I think that's mainly due to, again, growth selling off. Universal Display, they beat earnings, but they missed revenue, and that caused them to be down very, very significantly on the week. They were down like probably 15, 20%. How much were they? They were down, 25% on the week, which is insane. I do have a pretty good sized position in them as well, although thankfully my cost basis is like $130 a share, so I'm still up a decent amount, but very surprising to see there, because from what I can tell, they didn't release that bad earnings. But I think they partially they released bad earnings, partially the market sold off as well. And the last one for the week is ExxonMobil. They did beat earnings and revenue. They were actually up slightly on the week. So again, that is earnings from this week. Basically, long story short, it looks like we're in a pullback. We're in pullback mode here, but nobody knows how much it's going to pull back or when it will stop, when it will go back up again. Nobody knows. So my position, long story short, is near term over the next few months. I do think we trend lower, although it's obviously not going to be in a straight line. By the end of the year, I think we're in an uptrend again. So if you like the video, please like, comment, subscribe, and stay tuned for more.